Hello, everyone. Welcome to another edition of Incentive Crime, where we simplify tax, finance, and fiscal policies for businesses and individuals in Nigeria. I am your host, Faith Smart. Today, we are discussing a very important yet often overlooked topic: chargeable instruments. Many Nigerians sign agreements, issue checks, collect loans, lease properties, or even exchange land without knowing that some of these documents attract stamp duties under Nigerian law. So the big question is, could your business documents already be taxable? Let's break it down.
And I am Chineye Confidence. What are chargeable instruments? Chargeable instruments are the documents or agreements that attract stamp duties under the Chapter 5 of the Act. In simple terms, once a document creates a financial obligation, ownership transfer, or legal commitment, the government may require stamp duty to be paid on it. And this applies to the individuals, companies, investors, landlords, and even startups.
According to the Nigerian Tax Act, Section 128 to 139 sets out in detail how chargeable instruments are applied, as we will be discussing as follows. First is bills of exchange. A bill of exchange is a financial instrument used to facilitate payment transactions. It represents a written instruction from one party directing another party to pay a specified amount of money to a third party or bearer. This includes drafts, orders, checks, letters of credit, and any written document directing another person to pay money. Note: the law excludes banknotes or currency notes.
Now, the law goes further to explain something called bill of exchange payable on demand. This includes payment instructions that can be paid immediately or later, may depend on conditions or on certain funds, may be paid weekly, monthly, or at intervals, or even routed through another financial document. So even if the money is not ready yet, the moment the instructions exist, the law still treats it as a taxable financial instrument, because what matters is not the timing, it's the obligation to pay.
Next is the promissory note. A promissory note includes any written document containing a promise to pay money, even where payment depends on a particular fund, a condition, or a contingency. Example: I promise to pay 2 million to Mr. Adebayo on 30th June 2026. This written promise becomes a chargeable instrument. So, in summary, promise to pay equal to taxable instrument.
Also, contract notes and options. Now let's talk trading. If you sign a contract that gives you an option to buy or sell stocks later at a fixed price, that contract is also chargeable. And if it's a double option deal, the law treats it like two separate contracts, each attracting a duty. So yes, more options can mean more charges.
Property and real estate transactions. This is where most people feel it. Any transfer of real property is chargeable. That includes land sales, buildings, exchange of property, even barter style swaps, like property A for property B, are taxed if the value exceeds a threshold of 1 million or the minimum wage benchmark, whichever is higher. And if property is given in settlement of debt, that debt becomes the price tag for tax purposes.
And lastly is company capital. Share capital of the company is taxed when the company increases its capital or raises new funds. The government charges a duty on it because capital means economic expansion and that attracts tax. Then we have loan capital. This includes debentures, corporate loans, and funded debts, but it excludes overdrafts, short-term loans under 12 months, and some on lending arrangements. However, in some cases, Even the final borrower may still be responsible for the duty. So, structured corporate borrowing is taxable.
You wish to know more? Contact us at JE Consultancy Limited for more insights on chargeable instruments. And that brings us to the end of today's Incentive Cry episode. Don't forget to follow us for more breakdowns of tax laws and economic policies that affect your daily life. Comment and share. Until next time, stay informed and stay compliant. Bye.